Hey there, we will be going over the 2022 mid-year market update. So we will be diving deep into the data and also understanding where we're going and where we're currently at, along with giving you a little bit more information on what to expect as a buyer or seller. And I'll make sure to leave timestamps down below because this will probably be a little bit longer video so you can jump to whatever area you want to learn a little bit more about. So with that, let's dive right into it. My name is William Singh. I'm a local real estate agent here in Portland, Oregon, and we'll be diving into a lot of data. But before we really start, I want to bring up a few things. So one of the main points I try to do these videos for is to educate and inform. And this is one of those things where you need to use this information and actually critically think about what and how this applies to your own life and the decisions you're going to make. So again, one of those things where it might be a great situation for someone to buy right now, but it also might be a horrible decision to buy as well. So it just depends on what situation you're in, and feel free to reach out if you ever have questions or you're trying to understand or logically think through what would work best for you. And with that, I also want you to think a little bit more long term. So, when you're buying a home, you're usually looking at a longer investment. So, this is going to be at least 5 years and even up to 10 years. So, when you're feeling like the house is going to fall down or just the economy in general, know that we do go in cycles. And if you wait long enough, you will be able to get out of that cycle. Yes, there will always be downtimes and recessions, but there's also going to be bull runs as well. So keep that in mind when you're thinking about making a decision to buy or sell, and have that moving forward. So one of the questions is where we're at right now. So as of right now, we have about 1.4 months of inventory. So as you can see, this chart goes back to 2012. We, in the past 2 years, have been at very, very low inventory. And this does have a cyclical pattern. And this is usually where in the winter we don't have quite as much inventory, and then spring hits, and then we'll have a lot more inventory start coming on, and then we'll have more inventory come on near the end of the summer, and then they'll start dipping back down when we start hitting that fall and winter time. So just something to kind of keep in mind, especially when we're looking at inventory. And with the current conditions that are kind of going on, we're starting to see a lot more of that buyer demand starting to peter out. This is allowing for us to actually have some breathing room and just realize that we have been in a crazy seller's market within the last 2 years. This is not a quote unquote normal market to be in, and we're shifting much more towards a normal market. So one of those things where we'll start to see more listings on the market. Houses will most likely sit for a longer period of time, and this is something where we're starting to reach or go back towards more of an equilibrium. So one thing to note is if you're looking at the past 4 years, the black line is the 2022 inventory or new listings that are coming on, and we're basically right on par with the 2019. So even in the 2021, you're noticing that we had a little bit more inventory going on, but there was a lot more buyer demand during that time. So that's why we had a significant amount of homes that were being sold so quickly. So just one of those things to keep in mind. And then we're also looking at median days on market. So with this, you'll notice that for 2021, it's been very, very low. So this is probably when we were at probably the worst time for a lot of buyers. And then as this kind of starts going up, that means that we're going to have more and more time for these houses to be sitting. And it's just something to start really adjusting as a seller to understand that the market is changing, and it has changed significantly within the last month. The difference between now and January, February is significantly different, where maybe we'll see a house sit on the market for maybe 2 to 3 weekends instead of being gone within that first weekend. Moving on to the amount of percent drop. So this has been something where you'll see this huge spike right now. This is in 2022. And with that, it's mostly because sellers are now realizing, hey, we can't be asking super high or asking for price that is very high. The time where sellers were able to put any number up there and then expect 50 to 100 over asking is gone. Now we're going to start seeing a lot more homes that are getting under contract that are much more closer to that list price. And if you overprice your home and you're trying to basically get as much money as possible, which is great, it might create a situation though where your house stays on the market for a long period of time. And then just know that the amount of views you usually get as a listing usually will decrease over time. So you get a huge bump initially and then it starts decreasing. So with that, sellers who put their home on the market and they're overvalued or the list price is too high will most likely get punished. So with that, we'll be diving into the demand and supply equation. So these are just factors to really understand, and this is where we're going to be diving into a lot of numbers and charts and things of that nature, just to have a better idea of where the demand and supply factors are. One of the things to note in this as well is that we are much different from a local level versus a national level. So when I'm talking about these charts and graphs and things of that nature, I'm typically looking at more of a local level. So for example, housing prices, we'll be looking at things of that nature that are, again, much more in the Tri-County area, which is Washington County, Multnomah County, and Clackamas County. So kind of going over these demand factors, we're looking at housing prices, number of qualified buyers, so kind of population growth, housing alternatives, so whether or not it's easier to rent versus buying a home, and then consumer preference. So this kind of raises the fact that now people are wanting a lot more space. They're needing space for offices, or if they're having kids, things of that nature, and then also consumer expectations. And this is kind of what people believe in the future. So kind of looking at the demand side of things, the population growth is kind of slowing down a fair amount. But in terms of what we're expecting and what we're projecting, and this is based off of the U.S. Census Bureau, is that we're expecting this to go up. So the amount of population we have here is very indicative of how much demand there will be. One of the other things to note about this is that we, for the generations for 25 years to 54 years, we have a large portion of our population in these home formation years. So this is still a very large portion of the population here that are wanting to buy a home or will be able to buy a home. Now with this, renting has become much more cheaper. And the main reason for this has been the fact that interest rates have been rising significantly. So you'll notice basically back in February, the rates were around 3, and then they just started skyrocketing. Basically after December, we really just start seeing the rates rise, and it creates this frenzy for a lot of buyers to basically lock in and buy. And that's where we've kind of hit that point where we're in the 5s to 6s in terms of the interest rate, and we've been kind of going up and down. But just something to note that it has gotten a lot more expensive to now buy. With that, we're also seeing large raises in inflation. So this is something where in 2022 we hit 9.1% in terms of inflation. So the cost of goods, that's including rent, utilities, things of that nature, have all gone up quite significantly. Just within Portland, the Tri-County area, we've seen rents grow about 26%. So just kind of keep that in mind, that as we kind of move more towards this time where it's actually a little bit cheaper to rent, those rents will probably continue to rise, even though it's becoming more unaffordable to buy. So I just wanted to kind of bring up a chart of the interest rates and kind of give you a little bit more of a historical understanding. So this is one of those things where we have had you'll see this huge jump right here. And these rates, historically, we were just used to that about 3%. But now we've kind of jumped back up, and we're getting pretty close to sometime after the 2008 recession and kind of actually before. So if historically you're looking, rates really aren't that dramatically high. And the main reason why rates are increasing right now is because we're trying to slow down the economy, and the Federal Reserve is trying to reduce inflation as much as possible. So I was able to pull this from Mike Nuss, who is at Rarebird, and he did a great analysis of understanding where affordability is. So this is one of those things where if we're above 100%, that means that things are more affordable. So with this, we were at the 3.1% interest rates, and then the median income was about 96, 97 grand a year. And then we had the median sale price being about 511. So just with that in mind, we're at this 115% for the affordability. Now, with those interest rates starting to rise and the sale price of homes increasing as well, we are now down to 87.63. So a much more or much less affordable market. Now, this kind of creates two situations. In order to make things more affordable, we would need to either decrease rates or we would need to decrease the median sale price. So this is one of those things where it's probably going to be a little bit of an equilibrium, where instead of seeing a huge maybe drop in rates, we'll probably see a slight drop in rates and then also slight drop in the median sale price to really come to this equilibrium. So just something to kind of keep in mind, or have a better understanding of, if we wanted to keep affordability something that is kind of continuing to help out with the demand side, that's what would need to happen. So now we're going to be jumping into the supply factors, and I'll be going over new construction, existing sellers, and distressed. So we have a lot of actually great data on this, and in terms of new construction, we have kind of other factors within this to understand. So one is going to be labor, one is going to be supplies, and others are going to be regulatory costs. We're also going to have to understand that we have an urban growth boundary here, which means that we can't build as fast as we can. It usually starts expanding every about 10 years, so we're constricted in terms of the space we can use. With this, this is a map of the US and basically permits, and the red spots are typically areas that there have been a lot of permits. So this is again taking the understanding that Portland is definitely different in the sense of how much we're building versus some of these other areas like Florida, for example. A lot of things can be built a lot faster. There's not as many regulatory hurdles and things of that nature. So that is where Portland differs as well. And if we're also looking at the building permits, you'll notice this is the kind of 1990s to 2008, and then 2008 it dropped off. This is specifically for the Portland metro area, and you'll notice that overall it's much higher during this time frame versus right after the 2008 crash, where we really even haven't gotten up to these higher points of the amount of construction we needed. So again, one of those things, we're at a deficit in terms of being able to get the amount of homes or increase the amount of supply to meet the demand. Some other things to note is that building materials are still very costly. So lumber futures has stabilized a little bit more, but we're still seeing a large amount of delays in terms of getting things that are manufactured, things of that nature. So we're still trying to catch up to where we were at before the pandemic. And I could see that taking another probably 6 months to a year, depending on how much the economy slows and how much these interest rates really help out in terms of cooling down the market. On top of that, we have a fairly low labor participation rate. So one of the things that is noted is that usually construction is one of the first industries to go. So especially during the early days of the pandemic, it basically just kind of dropped off by quite a bit. And we haven't really seen this recover quite as much as we were hoping. But again, this is within the Portland area. And then we're looking at the second major factor, which is going to be the existing sellers. So some things to understand is kind of the refinancing side of things and interest rates. So as of right now, based off of Redfin data, 55% of homeowners have a 4% or less interest rate. So that means it's more expensive for a current owner to basically buy another house. And that's one of those things where this will kind of push a lot of current homeowners to stay in their home, because there's not a huge incentive for them to downsize. It's either that or they are leveraging those lower interest rates to then rent out their place, and that will allow them to probably have a positive cash flow, and then allows them to buy another place. So it's one of those things where it's not really pushing as many sellers to sell right now. And kind of looking at interest rates again, we just had a lot of people refinance during this time. So this is kind of the catch-22 for buyers right now, is if you want to wait, then you're probably going to have a higher monthly mortgage payment. But we are looking at going into a recession, which historically speaking, after recessions, you are going to see a decrease in rates. So if buyers buy right now, then you'll probably lock in an interest rate that's probably going to increase over time, and then it'll decrease once we really hit the full swings of the recession. And then from there, we are then, you'd be able to refinance, very similar to a lot of the homeowners right now. So just kind of keep that in mind as a buyer, that it can be a win-win in the situation of, if you buy now, you can then refinance at a later time. And again, we're trying to think of things in a long term. So if you're looking at that 5 to 10 year span, that's really where we need to be looking at. It's kind of like trying to day trade. You're just always on those ups and downs, and you're always trying to time the market, but it's really about the time in the market that you're doing. It's very similar to a lot of investing advice in terms of looking at the long-term perspective and not getting scared and pulling out all of your stocks when there's a crash, because eventually those stocks will then increase. This is kind of the idea of index funds. So with that, we'll be diving into the third factors for supply, which is distressed or REO properties or bank-owned properties. This happened a lot in the '08, and what's something that's very different is that we have much more strict lending standards. So back in '08, there were a lot of possibilities for basically anyone with a pulse to get a loan. And this is something that did not help when those loans were basically called due. A lot of people were going through foreclosures and things of that nature. So with that, the Portland market, so you can see the percentage of mortgages that are in delinquency. So if you're looking at the national average or the US, we're still a little bit below the 1% mark. And again, this was if we're looking at comparing ourselves to the 2008 mark, we're seeing a high of maybe 4%. So we're relatively low in terms of those delinquency rates. So if we start seeing those numbers dramatically increase, then that's something to be aware of, that we'll probably be seeing more inventory come online. So the thing with this, though, is that our unemployment rates aren't at that point. Our unemployment rates are still very low, historically speaking. So something to kind of take a look at from that national level. This is Portland's at 0.2%. And then if you're looking at other areas like Medford, that's 0.5, Salem, 0.5, and then Eugene is at 0.4. And then if you're looking at in South Carolina, like, there are other areas that are much more susceptible, or you'll see much higher mortgage delinquency rates. So Portland is just not one of those ones. So we will be diving into expectations. So this is the part where as buyers, you just need to understand affordability. If you're looking to buy, look at that long-term perspective. You're looking at that 5 to 10 year perspective of, can you afford this monthly mortgage payment? And just know that the longer you wait, the longer the rents will increase, and it might become unaffordable for you as well, especially if the values of homes continue to rise. And based off of all the data right now, and unless there's a huge black swan event, they will continue to rise. And then if you're looking at interest rates, it's again one of those things where those will continue to rise. I do not like pushing people into saying, like, you need to buy now. It's one of those things where it has to make sense for you financially. And it might be something where you're traveling and it just doesn't fit what you're looking for right now as well. So just know that if you're going to be buying a home, look at things from a long-term perspective, and if you're going to be there for 5 to 10 years. And at that point, you can usually weather the storm of a recession or something of that nature. Do note that the rent will continue to get more expensive. As previously stated, uh, we are seeing a 26% increase in rents in the last year. Uh, and this will probably continue to go up, or it will still have a positive direction in terms of rents continuing to go up, because when people cannot afford a home, then they switch to renting. So I've seen, especially in that 3 bedroom or more rentals, those prices are increasing a lot faster. So just something to kind of keep in mind. And then also expect, if you are on the search for homes, that offers will probably be a lot closer to the list price, and you might be able to get some closing costs. Again, that really depends on the situation you're in and is very dependent on the home. But at this point, it's going to be a lot easier to negotiate with sellers, and it's not going to be something where you're basically selling your firstborn in order to get a home. Now, also note that property values will probably level off or slightly rise. We have been in an extraordinary market these past couple of years. So just know that if we do start seeing a cooling off, it'll probably be leveling off a little bit more, and then it will most likely rise. And again, this really depends on what market you're looking at, whether it's Beaverton or it's going to be in Gresham. So just kind of keep that in mind. Now, moving on to sellers. These are some things to kind of expect, but you will probably need to price a little bit more aggressively. If you're trying to go really high above that range that buyers really feel comfortable, then you're most likely going to get punished for that, and your house will sit on the market for a longer period of time. But again, just one of those things where you're going to want to talk to your agent and really understand where you're at on that range. And if you're willing to wait it out, then it might be something where you're okay with having it on the market for a longer period of time. But again, just expect that things will slow down. The urgency from buyers has greatly diminished because interest rates have risen so dramatically. And then in terms of understanding that there will be more inventory. So with this, you're going to have, as sellers, you're going to have a lot more competition against other sellers. So instead of you being kind of the okay home, you might need to spiff up your home a little bit more to make it a little bit more appealing for buyers. And again, one of those things where now is really a good time to invest in a good listing agent. The reason being is that in the last 2 years, you really didn't have to do a ton in terms of communication with the listing agents to see where things were at. And now sellers are getting a lot more antsy. They were kind of expecting what it was maybe 2 to 3 months ago, and that is just not the market is right now. So just be very aware of that in the selling process. However, this also opens up the opportunity for sellers who are looking to now buy other places. And this allows them to potentially have contingent offers, which means that you can sell your home at the same time as you buy another home. This was not really possible within the last 2 years, but within a couple months, we've seen a huge shift, and now it's being much more viable option for you to be contingent. So just kind of keep that in mind. If you found any of this information helpful, it would be wonderful if you liked and subscribed. It would be super helpful for me and the analytics that go behind it. Hopefully this can help other people and educate people. If you have any other questions, feel free to reach out. I'll make sure to have my information down below. And thanks so much.